Dear students, we already know in income tax 2 we have three different heads of income of which we have to compute the taxability of these incomes. In income tax law, we have five different heads of incomes, as you know, and which we already calculated it. One is income from salary and income from house property, which we already discussed in the first semester of BCom. In this semester, we computed the other three different heads of income, which is computation of income from business or profession, computation of income from capital gain, and computation of taxable income from other sources. Now, we are today going to discuss about the computation of gross total income as well as computation of taxable income under the provisions of Income Tax Act. So, the gross total income means the total of income from five different heads, such as the income from salary, income from house property, income from capital gains, income from business and profession, and income from other sources. The total of all five heads together is called as gross total income. But one thing you should understand is that that is not what the income on which the assessee needs to pay the tax. Gross total income is merely total income earned by an assessee during the previous year, in our case the previous year 2018-19. So whatever the income which is earned put together from five different heads is called as a gross total income. Now from the gross total income, the assessee will get some deductions, some respite, and he will get some exemptions under the various provisions of Income Tax Act, for which his income will be deducted and finally the taxable income will be computed. Now, how to compute the taxable income after deducting various available deductions under the provisions of income tax? That is what today we are going to understand. So, the assessee, in our case we are discussing only about the individuals. We are not going to discuss about any other types of assessees compared the companies, the partnership firms or HOAFs or association of persons. We are not going to discuss about that. We are only concentrating only on the tax liability of individual as per our syllabus. Now, the deductions are listed under the section 80C to 80U under the provisions of Income Tax Act of 1961. Now, what are those deductions and how much an assessee will get deduction for these under these sections? First one is under section 80C. Under section 80C, an individual will get deduction for the savings he made in various listed savings under the provisions of the Act. The 80C deduction will be available first on any insurance premium paid by the assessee on the policy taken by the assessee on the life of himself or on the life of his spouse or his children. What is the extent of exemption he will get? Under the provisions of Income Tax Act, he will get an exemption to the extent of actual premium paid by the assessee during the previous year or 10% of the sum assured as per the provision. Say for example, if he has taken a policy of rupees 1 lakh, he will, if he pay insurance premium less than 10,000, he will get the full amount of exemption. Say for example, if he paid 12,000, then the exemption will be only 10,000 because the sum assured is 1 lakh and he will get only 10% of 1 lakh as an exemption. Even though he paid insurance premium for 12,000, he will get exemption only for 10,000. That is the provision under section 80C. And one more condition is that if the assessee taken any insurance premium, any policy on his spouse, on the life of his spouse or children, the condition says that the spouse should be dependent on the assessee and the children should be minor. If the assessee did not fulfill these two conditions, then the premium paid on the life insurance of the spouse and children will not be allowed for deduction under section 80C. This is one, life insurance premium. Apart from that, under section 80C, he will get deduction for any mutual fund he purchased, any principal amount of loan taken for the construction of house will also be deducted under section 80C, and also he will get deduction to the extent of tuition fees he paid on the education of his children to the extent of maximum of 2 children. Okay, these are the some items generally we will get in the examination on which if the assessee made a saving, he will get an exemption, but this exemption should not be more than rupees 1,50,000. Maximum deduction an assessee will get under section 80C for the various savings such as life insurance premium, purchase of mutual fund, purchase of shares and debentures, and repayment of housing loan principal, and invested in various mutual funds, such as such savings will be exempted maximum of 1,50,000. And one more thing which you have to remember is that if any savings made in the provident fund also, whether it may be statutory provident fund, whether it may be recognized provident fund or public provident fund, on that savings also the assessee will get deduction under section 80C to the maximum of rupees 1,50,000. So this is the exemption under section 80C. One more deduction which you have to remember is that any deduction under section 80D on the medical insurance premium taken by the assessee on his health or on the health of his spouse or parents. The maximum deduction under section 80D for the medical insurance is 25,000 only. Anything more than 25,000 will not be accepted. The rule is very much clear. The exemption will be only to the 25,000 or actual premium paid, whichever is less. But the assessee, if he is a senior citizen, he can claim deduction up to rupees 30,000 under section 80D. And then the third deduction which you are supposed to remember is under section 80DD. 80DD exemption says that if any medical expenditure incurred by the assessee on the dependent children, on the health of the dependent family members, the exemption will be up to 75,000. But if it is a severe disability, then exemption will be up to 1,25,000. So exemption under section 80DD gives you exemption for the medical expenditure incurred on the medical treatment of the spouse or dependents up to rupees 75,000 for the normal disability and 1,25,000 for severe disability. Now the next one which you are supposed to remember is that section 80E. 80E talks about any interest paid on the loan taken for education. So any educational loan is taken by the assessee. On the education loan, if he pays any interest without any maximum limit, the entire interest paid by the assessee will be exempted under section 80E. So these are the various sections. Once part of deductions which will be asked for you in the examination for 6 marks. Okay, so what are the exemptions or deductions which you have to remember? One is 80C for the savings, and the next one is 80D for the medical insurance premium, and the next one is 80DD for the medical treatment of a disabled dependent, maximum of 75,000 or 1,25,000 for the severe disability, and educational loan interest. These are put together comes from 80C to 80E. The total of these will be deducted from the gross total income. The remaining amount will be called as taxable income, on which the assessee is supposed to pay the tax. And these are the savings, medical insurance, medical treatment, and interest on educational loan. Next part is the deduction under section 80G. 80G deduction will be asked separately. It will not be included under 80C, D, D or E. It will be asked separately. The 80G talks about the donation given by the assessee to the various institutions. So these 80G talks about only deductions regarding donation given by the assessee. These donations are divided into two parts. One is the entire donation given by the assessee will be exempted. We call it as a 100% exempted donations. And the second part is that only 50% exempted donations. 100% exempted donations talks about various items. It is listed around 27 items are there listed in the 80G provision, which includes any donation given to charitable institutions, international research organizations, any donation to given to universities, or any donation given to the colleges which is a national prominence, any donation given to any charitable trust run by the non-governmental organizations, or Prime Minister's drought relief fund, CM's earthquake fund, and the Chief Minister's drought relief fund or flood prevention fund. These are the deductions which are comes under 100%. And second and last part is that 50% exemption. So 50%, under 50% exemptions, only 5 items will come. One is donation to Jawaharlal Nehru Fund, donation to Indira Gandhi Fund, donation to Rajiv Gandhi Foundations, and then children, National Children Fund, and then deduction under section 80G 50% for Prime Minister's drought relief fund. Only these 5 items comes under 50% deduction, and remaining will come under 100% deductions. So these are the items which is deducted from 80C to 80G, and we will get some other exemptions which are not related to the individuals, especially except 80H, which talked about any housing rent paid by an assessee who is not receiving HRA. Apart from that, no other exemptions will come as far as the individual is concerned. So these deductions from 80C, 80D, 80DD, 80E, 80G, 80H. So all these total of deductions will be deducted from the gross total income, and the remaining amount will be called as a taxable income, on which assessee is supposed to pay the tax as per the provisions of Income Tax Act. This is the deductions available to individual under Income Tax Act. In the next segment, we will talk about other part of the computation of tax liability in the next segment. Thank you.